Good morning. It is Thursday, March 12, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East has reached a moment of unprecedented intervention. Following nearly 2 weeks of conflict that has effectively choked the Strait of Hormuz, the International Energy Agency has announced the largest coordinated emergency oil release in its history. All 32 member nations have unanimously agreed to release 400 million barrels from their strategic reserves to stabilize global markets. This historic move comes as the Pentagon reports the heaviest day of strikes against Iranian military assets since the conflict began, even as President Trump suggests an end to hostilities could be near. Despite the military optimism, the humanitarian and strategic toll continues to mount, with casualties rising and regional leaders like India and France navigating a high-wire act of diplomacy to prevent a permanent collapse of the rules-based order in the far north and the Persian Gulf.
Transitioning from the front lines to the broader global economy, the narrative is one of relief tempered by long-term structural pain. Oil prices, which had touched four-year highs, plummeted over 11% yesterday, with Brent crude settling near $87 as markets processed the dual impact of the massive IEA stock release and the potential for a swift resolution to the war. However, this recovery remains fragile, as Europe's industrial heartland faces significant strain. Volkswagen has announced it will shed 50,000 jobs by the end of the decade, citing the combined pressures of falling sales in China and the impact of recent United States trade policy. Economists warn that while the energy shock may be receding, the underlying trend toward protectionism and high-stakes industrial policy is creating a divergent growth path where the United States may emerge as an unexpected winner while traditional manufacturing hubs in Europe and Asia struggle to adapt.
In the realm of finance, all eyes are on the resilience of the technology sector as it leads a broad market rebound. Following the late-month volatility triggered by the energy crisis, Wall Street saw a strong recovery yesterday, with the FTSE 100 rising nearly 2% and the S&P 500 recovering early losses. This optimism is being fueled by a historic corporate milestone, as the first $300 billion investment deal in United States history was announced between the administration and India's Reliance Industries to build the nation's first new oil refinery in 50 years. While the energy sector finds a new floor, the financial world remains on high alert for private credit defaults, as the ripple effects of the Iran conflict continue to expose vulnerabilities in highly leveraged sectors. Investors are now closely monitoring for a potential 30% breakout in the Nifty index, signaling that emerging markets may be the next frontier for growth as capital seeks haven from the volatility of traditional Western markets.
Turning our attention to the technology sector, the focus has shifted to the massive build-out of artificial intelligence infrastructure and the arrival of the agentic era. In Silicon Valley, Micron Technology and Applied Materials have formed a landmark partnership to accelerate the development of next-generation AI memory solutions, with research and development centered at the new $5 billion EPIC Center. This collaboration aims to shorten the commercialization cycles for high-bandwidth memory, which has become the primary bottleneck in the global AI race. Simultaneously, Synopsys has unveiled its vision for an orchestrated multi-agent design workflow, signaling a shift where AI is no longer just a tool, but an autonomous participant in the engineering process. As the silicon economy enters a projected peak in annual sales, the primary driver of strategic advantage has shifted toward the ability to secure the energy and hardware required to sustain these localized tech ecosystems.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are currently facing a period of intense structural rewiring. While the IEA release and potential ceasefire have provided a psychological boost, the physical reality in the Strait of Hormuz remains one of extreme congestion, with over 150 vessels still at anchor. Maritime insurance premiums have skyrocketed by nearly 170%, forcing carriers to maintain expensive reroutes around the southern tip of Africa. Logistics providers are warning that even if the strait reopens tomorrow, the ripple effects on global port capacity and equipment availability will be felt for months. Companies are responding by treating supply chain reliability as a core enterprise risk, rapidly adopting AI-driven inventory positioning and digital twins to ensure they can withstand the next shock in an increasingly unpredictable world. That concludes our global briefing for today. Thank you for joining us.